Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm going to go back to the stock market and look at shares of Broadcom, up a whopping 19%. I want to get more with Kunjan Sobhani, Bloomberg Intelligence senior semi-analyst. So we know the story. The numbers for its AI revenue were super high. Their outlook looked really good. Is it justified in a $1 trillion valuation right now?
I mean, look, going into the earnings, the top concerns were how is AI going to do next quarter? What are the numbers looking like for 2025? And sort of no visibility beyond that. So can this rally sustain? Those numbers that are driving the stock really gives investors 3 to 4 years quantifiable target and milestone to look at, and now just track the execution. And those numbers are pretty huge. I mean, you're talking about 3 to 4x fold growth in just the SAM, just from his 3 customers, not even including the additional 2 that they're working on.
So, Kunjan, help us think about Broadcom now in comparison to NVIDIA and maybe even some of the other players. How's this industry as it relates to AI? How is it shaking out here?
Yeah, I mean, when you look at Broadcom just barely 6 months or a year ago, people didn't even think of it as an AI company, right? It was primarily the investor base. It was really loved for its free cash flow generating ability, highly profitable, sustainable, slow, mid to high, high single-digit grower. Now suddenly AI is going to become a huge chunk of its semiconductor revenues, and in combination, you still have the software revenues at high margin generating significant amount of cash. So you have this really fast-growing NVIDIA type, or even growing faster in certain areas going forward than NVIDIA AI story, along with all the goodness of what you want from a large cap, which is high profitability, high operating margin, high free cash flow.
For the non-AI stuff, like the chips that go into like phones and cars and all that kind of stuff, how is that part of the business doing? Because it hasn't been doing very well. We've been waiting for their cyclical recovery to kind of kick up. Where did Broadcom land on this?
Yeah, I mean, that they are aligned very well to what rest of the cyclical semis are doing. I mean, look, 24 was the bottom for most of its business. We do expect recovery starting early next year, but it's going to be really slow turning corner. So we don't expect any sort of fireworks there. But the good news is the way AI is expected to grow, that portion of the business is going to shrink and become a significantly smaller part of the chip business.
All right, so as you step back from the semi-space these days, Kunjan, what are the conversations you're having about the space in general? Is it NVIDIA all the time? Do I want to own a basket of these things? What are some of the conversations you're having with your investor clients?
Yeah, the top question is sort of searching for the next NVIDIA, trying to add more and more AI exposed names, and who else in the semi sector and the peripheral sectors, whether it's foundries, whether it's memory, whether it's semiconductor equipment providers, can benefit from this broadening AI boom. The first beneficiary, almost entire beneficiary, was just one name, NVIDIA. So that's a conversion we have, and we have been actually calling out Broadcom and Marvell for quite a while now that these are going to be sort of the next set of beneficiaries from the coverage that we cover.
When we take a look at Broadcom, though, and the stock reaction in the near term, are we borrowing faith from like 2025 or 2026, or is this like legit comp number rally?
I mean, there is definitely a huge weightage given on their ability to execute to that large SAM that they have laid out. Investors who have been following Hawk for many years don't take what he says lightly. There's a big, degree of conviction in what Hawk says and can deliver. So there is definitely a huge reliance in what you see in the stock movement that they will be able to sort of meet or execute on those numbers.
Right.
So when we see like a big number coming out of the likes of Broadcom, does that give you pause for the NVIDIA story that maybe there's a market share shift going along, that maybe the competition is starting to step up here?
Not in the near term. Look, the merchant silicon GPU that NVIDIA sells versus the custom that Broadcom does right now are being used for 2 different use cases, and both of those use cases, the demand is booming, right? So it's a win-win for everyone right now. Eventually, in theory, if this demand rally does normalize and there is some kind of digestion, look, there's only so much these hyperscalers will spend, right? So eventually down the road, we will come to a point where they will have to decide, do they want to spend more in their custom and the GPU, and what are people demanding for? At that point, there will be wallet share competitiveness, but not at this given point, just because the use cases and applications are very different.
They get the majority of their revenue really from Apple and WT Microelectronics, right? Then it comes sort of Alphabet and Meta with about 6 to 8% of its revenue. Thank you so much. Supply chain analysis function on the terminal. Are they trying to diversify that in a meaningful way, or are they comfortable with that sort of weighting?
I think it's just organically going to get diversified, right? Okay. The wireless from Apple is not a fast-growing business. It's sort of mid-single digit at best, right? So, and there are some concerns around that. It's too mature to talk about it. But even if you assume that business continues, and like the speed at which the AI business is going to increase, the speed at which Google, Meta, and these other hyperscalers are going to become a larger portion of Broadcom, it is organically going to diversify away from the top two customers that you pointed out.
All right, Kunjan, thanks so much for joining us. Kunjan Sobhani, senior analyst on semiconductors. He's over there at Bloomberg Intelligence, based in our San Francisco office right there in Silicon Valley, close to all those big tech companies that he covers. So that's a real advantage for us. Kunjan Sobhani joining us there. That's a heck of a move for a company, you know, a $1 trillion market cap stock to move 20%. I've said it when I was seeing some of the moves from NVIDIA when they were moving 10, 20, 30% in a day. This is huge amounts of shareholder wealth being created in this space. It just, the absolute dollars are kind of stunning to take a look at it. So this isn't any penny stock out there. So
new.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's get to overseas. We're going to France. President Emmanuel Macron appointing François Bayrou as France's new prime minister to navigate a fractured, I feel like that's a nice way of saying it, political landscape. And there's a to-do list that's very difficult. Katz, as Bloomberg Paris Bureau Chief, joins us now. Alan, does he have to get approved or voted for, or is he just in power and then he's going to make it work?
So the latter, he's just in power and he has to make it work. In France, the president gets to nominate whoever he wants as prime minister. So great. So now you've got François Bayrou, but he has to get a few things done. Most importantly is the 2025 budget. And that's what caused his predecessor, a guy named Michel Barnier, to get booted out in a no confidence vote last week. So that's going to be his first order. Well, his first order of business really is getting a cabinet together, getting a government together. And then it's going to be trying to get a 2025 budget passed. So that's really the first things he's got to start to do. And it's not going to be easy.
So, Alan, is there any reason to believe that this new prime minister will have any better luck with the right and the left, which caused the demise of the predecessor?
So it's a good question. I guess the best answer is maybe. He's a centrist, right? So he has been known to do. I mean, originally, sort of his party was more aligned with the sort of the center right back in the 80s and the 90s. But then he famously voted for a socialist for president in 2007 rather than the conservative guy. So he's reached out to both sides over time. He also was very famous for having supported Marine Le Pen's right to run for president in 2002. In France, you have to get 500 signatures from local officials to be able to run for president. And he said, well, she's very popular. We can't not have her run. That would be really bad for democracy. I don't support her personally, but I support her right to run. And the far right remembers that. So he's got sort of possibilities. But then really getting people on side is going to be much more difficult. Michel Barnier, the guy, again, who just got ousted, he sort of had the far right on side for a while also until they weren't. So far, everyone today has been giving, I guess, sort of mildly positive comments. They're going to say, we'll wait and see, or it depends on what he presents. But it's really not clear that he's necessarily going to have any better luck than Michel Barnier did.
What does the far right and the far left want?
Very different things. But mostly what they want is someone who's going to allow them to look good to their voters as they get toward the 2027 presidential election. That's one of the problems that we have in France right now, which is that you have this big bloc on the left and a big bloc on the right. On the right, it's led by a woman named Marine Le Pen, who's the most popular politician in many polls in France, and certainly the person who leads polls if the next presidential election was to happen today. The person who's frequently number 2, or if not number 2, number 3, is the guy on the far left named Jean-Luc Mélenchon. And the two of them are definitely looking to the next presidential election. So all of their decisions in the short term, in terms of what happens in Parliament, passing a budget or any other laws, is all about what does this mean for how voters are going to perceive me in 2027. And that makes for a very difficult relationship, because sometimes there are things that you might say, well, that's obvious, sure, they should like this, but then they don't. In the case of Michel Barnier, he basically gave in to most of the far right's demands, basically 3 out of 4 main ones that they had, and they voted, they voted for a motion of no confidence anyway, because they decided it was in their interest, in their longer-term interest, to do so. So that makes it really quite difficult.
Alan, thank you so much. Appreciate your reporting. Alan Katz, Paris Bureau Chief for Bloomberg News. How cool is it that we get people on the ground, really smart voices, pretty much everywhere around the world, and they come on the air with us?
Very cool.
That is such a great
and they really know what they're talking
advantage,
about.
And they know exactly what they're talking about. I want to ask about next time we talk to Alan, how big of a story is it in Paris and France, the reopening of the Notre Dame? Because when you saw the damage from that fire 5 years, I'm like, they're never going to fix that stuff.
Yeah.
I mean, how do you fix that?
I mean, we went to Paris last summer, and it was like, it's never going to.
Amazing.
They're going to be so behind, and then they did it. I would think that culturally, and the message it sends is pretty spectacular.
I mean, I give Macron a pat on the back and the French people a pat on the back, because that was awesome. How they.
But remember,
so I want to go over
egg prices and fuel prices.
Egg prices and fuel prices. I get it. So we'll have more on that coming up.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, so we get the Fed on Wednesday, highly expect to cut rates in December. The question then becomes what happens in 2025 if that neutral rate is moving up, as Bill Dudley, former Fed governor, was talking about on Surveillance. If he thinks the neutral rate is 3.5 or a little bit higher, what does that mean then for the trajectory of cuts? And then what does it mean for sectors that are really waiting for those cuts to kick in, like real estate, maybe private markets, private equity? We want to delve a little bit deeper into this with Miguel Sosa, head of market research and strategy over at Bluerock. He joins us now from Dallas, Texas. Before we get into the nitty-gritty of, say, private credit and real estate, just give us your broad views on 2025.
Yes, thank you, Alix. So we're excited about 2025. We think that the markets are poised to perform well. We've seen strong performance for 2024. With a change in administration, we think that the administration is very business friendly, so that should provide an additional tailwind, in addition to having the high interest rate environment behind us. And so what we're seeing is gradually moderating interest rates, a predictable and shallow decrease in that interest rate curve on the short end, stable in the 10-year side of the interest rate curve, of the yield curve. And so we think that 2025 will be a positive year for all asset classes.
All right, let's talk real estate here. Where do you see opportunities in real estate here? We've got the Fed cutting rates. I would think that's good for that asset class. Where are you guys seeing the most opportunities?
Yes, that's correct. So reducing the short end of the curve, the Fed funds rate, is beneficial indirectly for real estate because naturally it moderates the cost of capital. We're seeing opportunities in the industrial space, in the multifamily space, and really in the specialty space as well. And so these are all sectors that are seeing low vacancy rates. And so that helps to drive lease rates up because there is much more demand relative to the supply that's available. And if lease rates go up, the net operating income goes up. And NOI, for short, is a key driver of value. So what we've seen recently in the last 2 years is the capital values have come down significantly, but NOI has gone up significantly. So in other words, you can buy more real estate at a discount, and that real estate is generating more income. And so that will hopefully drive returns in the future.
How much of this is predicated on rates being cut from the Fed, and how much of it is just sort of the economic cycle?
I would say the majority is driven by the economic cycle.
Okay.
The change in interest rate environment really it inflated cap rates, which was the main driver why prices were down. But unlike the global financial crisis, which was the last big drawdown for real estate, there's very strong fundamentals that are driving real estate currently. Like I said, vacancy rates are low, and it's much harder to construct new developments, new property developments today versus 15 years ago because of inflation. Construction costs are up. The other factor, for example, specifically for the industrial space, is that we're all buying more products online, and we want them shipped to our houses faster. And so that causes demand for warehouses that are closer to city centers so they can get to our homes faster. But nobody wants warehouses in city centers or close to cities, and there's no vacant plots available for those warehouses. So there's that imbalance as well. We have examples across the board. Data centers, for example, another great example, because everybody is consuming more and more information constantly every year. So that drives significant demand for data centers.
I tell you, all those warehouses for servicing New York City and Philadelphia, they're right in my backyard and John Tucker's backyard in Central Jersey. Access to the New Jersey Turnpike, Garden State Parkway, all that kind of stuff. 287, you can serve both Philadelphia and New York.
Maybe that's why the UFOs were there.
Maybe.
Yeah.
Exactly.
Maybe we can make that link.
Maybe, exactly. hey, Miguel, let's say I want to go out and buy some commercial real estate. Is my bank going to lend me money? Where do I get the debt financing these days?
Yes, so typically commercial developers will go to specialty lenders, and depending on what type of property one is buying, if it's a fully developed and occupied building, it's stabilized, as they say, because the occupancy rate is high, then lenders are much more willing to provide capital for that and increase the loan to value on that property. But if it's a empty plot of land and it's a development project, then those are typically construction loans. And so there's a wide variety of sources for capital. Banks have typically been reluctant, especially recently, to provide capital for sectors that are struggling from like the office space, but there's certainly a broad variety of sources of capital, starting from banks all the way to individual investors who are happy to provide some of those short-term construction loans.
Before we let you go, for, say, private credit, where are the opportunities there going into 2025?
Yes, private credit is one of our favorite sectors specifically because, as I mentioned, the interest rate is in this Goldilocks phase where we aren't in 23 or 24 where we don't have that visibility or uncertainty of how long and how far interest rates will climb. And so interest rates are at a point where the peak is behind us, but they're not at zero either. And so that favors the lenders versus the borrowers. Now you can, especially in private credit and alternative private credit, you can receive 9%, 10% even interest rate on loans to corporations that are established, they're mature, they're cash flowing, and that are going to pay through that debt until maturity.
Miguel, thanks so much for joining us. Miguel Sosa, Head of Market Research and Strategy at Bluerock, joining us here talking about the commercial real estate business. And of course, our commercial real estate business, as is residential real estate, really dependent upon interest rates.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Here was a headline that was interesting. Well, I mean, I think for anyone listening, it was interesting. Is that Trump advisors are considering raising SALT write-off limit from $10,000 to $20,000. Why not 40,000?
Exactly. Why not just eliminate it? If you're going to go 20,
just move it up there.
How much are your property taxes?
It's a good question. Can you multiply like 14,000? I think.
Wow. Okay.
Is that
that's about around these parts.
Is that a wow nothing? Is that a wow that's not bad?
It depends. You go north of New York City into Westchester, and that's really low. It's like in the 20s for just a regular house.
No, I live in an apartment building.
Yeah.
Like a 1,400 square foot apartment building. And every year I feel like the property taxes goes up. That's when I knew I was an adult.
But you're
when
a hipster. You're in Brooklyn.
I'm in Park Slope. Park Slope is like the non-hipster place. It's where people go to have babies and dogs.
Okay.
Anyway, Henrietta Treyz is managing partner and director of economic policy at Veda Partners, and she joins us. How real can we take this salt tease?
Very seriously. So good news for you, for sure. I commiserate with folks who want it larger. This is the minimum I think they have to have for a tax bill to pass next year. The SALT caucus, and indeed a lot of the Republican gains in the House of Representatives, have come from new voters that they're finding in New York, Connecticut, New Jersey, California, states where these SALT caps are extraordinarily painful. And the members are being very clear and vocal. They've gotten more and more adamant and united over the last 7 years since this tax bill passed that they have to see a change to SALT if there is any tax title in any legislation going forward. So they'll try to get it in the first reconciliation bill. If there's a second, they'll try to get it into that. And they will threaten their votes, which with a 0 vote margin in the House means that you have to cater to their requests.
Henrietta, can you give us the latest on the expectations for confirmations of some of President-elect Trump's more contentious nominees for cabinet positions? Have we seen any movement one way or the other?
I think we have a long way to go here, and you can see the various factions coming out behind the scenes trying to sink or lift various candidates. One of the things that would make me expect those stories to continue negatively for example, his nominee Hegseth or for Tulsi Gabbard, is that there are other folks waiting in the wings who know that in the event that their nominations fail, they could be the ones to gain. So there's a lot of negativity that you see sort of in the behind the scenes work, specifically on Tulsi Gabbard, I would say, that is going to continue to eat into the next month of the conversation until the negotiations really start and the confirmation hearings start and they get these folks up for a vote in late January. So there's a long way to go. I think Tulsi Gabbard in particular is pretty imperiled right now.
Other news that struck me overnight was the Wall Street Journal reporting that potentially Trump could get rid of the FDIC and put deposit insurance in the hands of Treasury. Now, abolishing a whole unit of the government like that would be very rare. Can you walk me through what you think of that potential?
I don't take those claims particularly seriously. One of the things that we should just keep as our base case is understanding that Congress has the power of the purse. And that is something that the Supreme Court has stress tested in 1974 and in other iterations. Bill Clinton famously tried the line item veto, where he tried to just cancel out entire lines of funding that the federal government or Congress had authorized. It's just not legal. It is unconstitutional and runs afoul of so many different things. Plus, you have a lot of members who get really uncomfortable moving agencies into other auspices. Another example to pile on the FDIC thing would be the USTR. President-elect Trump has said that he's going to put U.S. Trade Representative and that office underneath the Department of Commerce. And immediately you see members come out of the woodwork and say, hey, that's not what we're into. That's not what it's supposed to be. Keep these two things separate. That was very similar to what we saw in Trump's first term, and ultimately those did not come to pass.
Elon Musk, Doge. It's been a week or so of, I guess, no news on kind of that front. Is that whole cost-cutting aspect, how should we think about that, and how might that play out in the first 100 days?
Yeah, I mean, we can talk about Doge. They can have committee hearings. They can form caucuses in the House and the Senate. They're even bipartisan now in the House. But let's look at what's really happening. They just voted on in the House a National Defense Authorization Act that increases defense spending by 1%. Next week, starting on Sunday, they will roll out a continuing resolution that provides $100 billion in additional funding for hurricanes and typhoons. There is additional aid to Ukraine. There's additional aid to a whole host of factors. And federal spending next year will continue to rise. Whether Doge exists and holds meetings or not, federal spending is going to rise into next year. They'll vote on it as soon as Thursday of next week. You can take that to the bank.
What else are you paying attention to as we head out of 2024 into 2025 as well? Not only from, President-elect Trump, but also President Biden.
The most important thing for me is watching the Senate and the House budget committees. I know it sounds wonky, but this is the single most important thing to watch going into next year. What we've already seen from Senate Republican leadership and new leader Thune is that they are appreciating and expecting for the tax bill to take all year to write. We started off with the SALT caucus conversation. It's because of that $1.2 trillion revenue raiser being completely unpalatable to 18 members of the House, that they're going to have to negotiate all year on a tax bill. So what that first tells me is that the deficit appetite for the tax bill is going to be very controversial. It's very problematic, and they want to take that vote much later in the year. They'd like to score some smaller sort of red meat wins on immigration, increasing border spending, increasing energy and oil and gas permitting. That kind of legislation and that strategy is going to come out on January 4th when House Republican leadership has a meeting with the full Republican conference to see if they can tolerate a 2 reconciliation bill strategy or just 1. So the conversations behind the scenes are already taking place there. Investors should be very much following that right now. It has huge implications for tax policy, for immigration, defense spending, deficit spending, bonds, everything happening now.
Henrietta, to what extent, if at all, do folks really, the folks inside the Beltway, the people that are there year in, year out, do they view President-elect Trump as a lame duck president?
I think there's 2 ways of looking at that. One, that you have an impetus to act immediately. So that's really relevant, for example, on the trade front. It takes forever to negotiate with foreign nations. We've seen that from 2017 and 2018. We still do not have a trade agreement with the EU. We do not have a trade agreement with Canada, with China. So I think the trade agencies are going to kick off much earlier in the second Trump term than they did in 2017. That year, we had to wait the full year for the tax bill to be written, and then we could get into the trade universe. This time, I expect the the tariff agencies, USTR, Commerce, BIS, to come out guns blazing immediately. So that's acknowledgement that you only have 4 years to operate, and it takes forever just to hold a meeting with China. To pick out what location you're going to be meeting in, if they'll even come to the table and negotiate with you in the first place. So I think lame duck has a sense of nothing will happen. On the trade front, I think it means everything needs to happen immediately so that you have and are taking advantage of the limited 4 years that you do have.
Which I love how you brought that up, because then it's a sequencing conversation, right? If you have taxes, you have immigration, and you have tariffs, and what's the sequencing of all of that?
Yeah, the sequencing is critical. So the tax bill is not going to be written until the end of the year. The deadline's not until December 31st. They will not do it until year end. Immediately then, you're going to have tariffs. And the tariffs are a massive hit on American consumers. $1.4 billion in real income per month hit from just the existing tariffs. So when we double them and put them at 35%, or higher, 60%, as President-elect Trump has advocated, that's going to be a substantial hit to the U.S. consumer in advance of any certainty about tax policy that will come at the end of the year. The immigration component also will happen immediately. You're seeing that in both Canada and Mexico now, as those 2 nations try to accommodate Trump before he comes into office, uses the IEEPA authority to impose tariffs and limits immigration that way. So you're going to see the hit to immigration and the tariffs much earlier than you're going to see any certainty around the straight line extension of the existing tax rates. And I think it's important to note that we're not talking about additional tax cuts to offset maybe the negatives of these tariffs. You're talking about a $4.6 trillion cost of just keeping tax cuts at their current rate, tax rates at their current rate.
All right, this is what we're doing, Alix. We're sending Henrietta to Washington to just fix things, just get stuff done. That's how good she is. Henrietta Treyz, Managing Partner and Director of Economic Policy at Veda Partners. I'd send her to Washington tomorrow to get stuff done. She knows what she's talking about there.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.